Hello, and welcome to the viewing of Financial Ratio Analysis. My name is Dr. Andrew Borg, and we will be discussing how financial ratio analysis helps to determine various aspects of a business, such as its profitability, liquidity, and solvency, in addition to how ratio analysis can signal how a company is performing over time while comparing a company to another within the same industry or sector. We're going to be looking at two what I call mega or well-known or well-branded companies, Disney World, hence Disney, or Uber. I know they're totally different when you look at these two firms, but if you think of them as service industries, they can be compared. So the first thing I wanted to discuss is why are financial ratios useful? And it's basically because they allow for standardization, flexibility, focus, and evaluation. Financial ratios provide a standardized method with which to compare companies and industries. Using ratios puts all companies on a relatively equal playing field, as companies are judged on their performance rather than their size, sales volume, or market share. It gives us the ability to compare companies to Walmart. It gives us an opportunity to compare companies to Amazon and so forth. When we talk about what does it mean that financial ratios can be useful for flexibility? Well, financial flexibility refers to a firm's ability to adapt to change in the future. Two ratios that reflect profitability are therefore related to risk, operating capability, and financial flexibility. And these are going to be your profit margin and gross profit margin. The gross profit margin is the percentage of the company's revenue that exceeds its cost of goods sold. It measures the ability of a company to generate revenue from the costs involved in production. The gross profit margin is calculated by subtracting the cost of goods sold from revenue, also known as COGS, and the COGS is the amount of its cost a company has to produce the goods or the services it sells. Net profit margin, on the other hand, shows whether increases in revenue translate to increased profitability. So net profit includes gross profit revenue minus cost of goods sold, while also subtracting operating expenses and all other expenses such as interest paid on debt and taxes. Well, what does it mean that financial ratios can be useful for focus? A net profit margin, for instance, of 1 means a company is converting all 100% of its revenue to net income. And yes, I know that's not going to happen. However, if a company has a really low profit margin, it may need to focus identifying the cause of low profit margin, such as costs, efficiency, and price of goods sold. Well, what does it mean that financial ratios can be useful for evaluation? Analyzing financial ratios can provide insight into a company's strengths, weaknesses, competitive advantages, and strategy. While different industries can have widely different ratios, comparing ratios of companies within the same industry is one way to dig further into a company's true performance. So who uses these ratios? Well, those are going to be your financial managers, your analysts, internal and external, your creditors, banks, and those of us that invest in bonds, and your investors, existing and potential. There are different types of financial ratios. I have them broken down as liquidity ratios, activity ratios, leverage ratios, profitability ratios, and market ratios. Liquidity ratios are financial metrics that are used to help financial managers, analysts, creditors, investors, etc., determine a company's ability to pay off current liability obligations without the need to raise additional external capital. These ratios additionally illustrate the margin of safety, as the lower the index, the greater the likelihood the company will have in difficulty to satisfy their obligations, their liabilities. However, these figures should be looked through the lens considering the payment index, the PI, which looks at the history and trends of borrowing, of aging, the repayment of borrowed funds. The PI score is typically from 0 to 100. The closer the company scores to 0, the healthier the company seems to be for paying their suppliers. Activity ratios are financial metrics used by a company, creditor, investor, and such to determine how efficient a company's operations are. It helps measure the firm's ability to convert balance sheet assets into sales or cash. It measures how efficiently a company is employing its capital or assets. If you find activity ratios declining over time, financial managers can rectify the situation by increasing sales, which would improve the asset turnover ratio, identify efficiency opportunities, could be improvement to maintenance of fixed assets, improve quality control and the like, or managers can sell off some of their assets and accelerate collection activities, or even automate their inventory or order systems. Leverage ratios look at how much capital comes in the form of debt, loans, and can they be used to access or assess the ability of the firm to meet its financial obligations. I'm going to repeat that. Leverage ratios look at how much capital comes in the form of debt or loans and can be used to assess the ability of a firm to meet its financial obligations. Leverage ratios are used to determine the relative level of debt load that a business has incurred and compares the total debt obligation to either their assets or equity of a business. Profitability ratios are financial metrics used by analysts and investors to measure and evaluate the ability of a company to generate income, profit relative to revenue, balance sheet assets, their operating costs, and shareholders' equity during a specific period of time. They show how well a company uses its assets to produce profit and value to the shareholders. A higher profitability ratio usually means the business is performing well because it's generating revenues, profits, and cash flow. The ratios are most useful when they are analyzed in comparison to similar companies or compared to previous periods. Market ratios are used to evaluate the current share price of a publicly held company stock. Current and potential investors use these ratios to determine whether a company's shares are overpriced or underpriced. And at that point, you should start thinking, hey, I should start thinking about intrinsic value and how intrinsic value impacts my market ratios. So when we first look at liquidity ratios, we're going to go into each one a little deeper. Liquidity ratios measures the firm's ability to pay off their short-term liabilities. Okay, so I like to think of it as, can the company keep their lights on without the need to raise additional monies? Okay, creditors, banks, investors, they want to know, can the company be liquid, have cash on hand to pay their bills when they come due? Activity ratios, also called efficiency ratios, Measures how effective the management team is to generate revenues with the assets they currently manage. So how fast is the company selling its inventory? How fast are they collecting on its accounts receivables? And how productive are the fixed assets in terms of generating sales? Leverage ratios, also called financing ratios or solvency ratios, is a long-term business indicator. And it says, okay, if I look at the assets or what a company owns, and liability and owner's equity is how did the company pay for the things it owns, I now say, okay, this debt ratio, leverage ratios are going to say, measure how much of the assets, things that the company owns or claims the company owns, are financed through debt and how much are financed through equity. I want you to think of just if you have a mortgage, a car loan, it's great to say I have this house and valued at XYZ, but how much of it do you own? How much of the car do you own, and so forth? When you look at the assets of a business, you have to look at, it's great to look at what they own, but how much do they own compared to how much are they obligated to pay in order to own? It's also important to note that the leverage ratios also have a direct impact on a firm's stock price. And a firm's stock price is a way for easy or cheap capital to be raised. So when you think of leverage ratios, you should start thinking, okay, I'm dealing with bonds. Bonds is debt. Debt is leverage. Leverage is risk. So for instance, say you have a company that has 1 million shares outstanding, and each share is worth $1. That company's valuation is $1 million. Now suppose that the market perceives this company as risky. The company just say took on a lot of debt and has just uneven cash flows, might have seasonality, which we'll get into in a little bit, but investors perceive this company now as risky. Well, that value of $1 per share might go down to 80 cents per share. Now your company, instead of being worth 1 million times $1, which would be $1 million, is now only worth $800,000. Harder to raise capital. So there has to be that balance between debt and equity to have that optimal stock price. And these are going to be related to your capital structure of your organization. Profitability ratios, they allow us to measure the ability of the firm to earn an adequate return on sales, total assets, invested capital. It measures the firm's ability to effectively employ its resources to generate profits. Market ratios is a way to evaluate the current share price of a public firm stock. These ratios are used by both current and potential investors, and to determine whether a stock is valued, undervalued, or overvalued. Again, start thinking of intrinsic value, that perception that might drive up or down a stock price. So let's take a look at what we have here. Disney versus Uber. Okay, again, we're going to look at them as service industries. I'm going to take first their liquidity ratios. We're going to look at the current ratio, which is current assets minus current liabilities. They're both coming from the balance sheet. And I can see that, the company's current ratio for Disney is 0.94, which indicates a poor degree of liquidity, which you could think of it as they only have 94 cents of current assets available to cover every dollar of current liabilities, compared to Uber, which has $1.68 in their pocket for every dollar they own. So as these figures, these are not only the figures to consider, though, when referring, looking at liquidity, if whether a company can pay their bills. I want you to start thinking, keeping in mind gross margin, which is something we'll talk about in a little bit. The next ratio is quick ratio, also known as the acid test, and that's taking the current assets minus inventory divided by current liabilities. This is more of a conservative test, and it's more of a conservative test because companies are saying, look, we've already paid for the inventory. They're treating it as a sunk cost. If we already paid for it and we needed the money, chances are we're not going to get dollar for dollar what we paid for it. We're not going to sell it. So perhaps we'd get 5 cents out on the dollar if we had to raise cash quickly. So let's just not include it at all. Now, we would assume Disney's current ratio, quick ratio or asset test to go down, because if you've ever been to Disney or you think of Disney, you can imagine their stuffed animals and DVDs and all the like that they have at their stores and online and so forth. So there's a lot you can pull out of the equation, pull out of the current assets. I was surprised, however, that Uber went up. So it made me think of investments that are coming to them, but it's something that we have to look at going forward. Okay, so in terms of liquidity, Uber seems to be much more liquid. On the other hand, it's not enough just to look at liquidity. You'd have to look at the assets behind the liquidity. So then we say, okay, let's look at activity ratios. If you remember, these are your efficiency ratios. And the first one is accounts receivable turnover, which equals credit sales divided by accounts receivable. Credit sales coming from your income statement, accounts receivable from the balance sheet. And the receivables turnover ratio is used to quantify a company's effectiveness in collecting its receivables or monies owed by clients. The higher the number, the better. Suggests that their clients are paying their bills quickly and that a company is conservative when it comes to extending credit to its customers. Now, when I look at Disney's 4.49 compared to Uber's 3.9, nothing screams at me and saying, wow, there's a big difference. They're kind of flat, but you got to give a point in that. You got to remember that these ratios that we're pulling are from, just say, March timeframe, as COVID was really impacting these two companies, the financials of these two companies. The next thing we're going to look at is the average collection period, which we take in 365 to represent the number of days in the year, divided by the ratio we just did, the accounts receivable turnover ratio. Now, in business, they typically use 360. For academia, they use 365. It gets you to the same result in terms of making a decision and taking a view. Most businesses require invoices to be paid in or about 30 days. So with the average collection period, if a company was averaging 38 days, it would mean that the accounts are often overdue. So a lower average, say around 26 days, would indicate collection is efficient and effective. So when you look at Disney, you say, oh my God, it's 81 compared to Uber, which is 31.32, which is right in line with 30 days. That asterisk by that 81 indicates that it's quarterly. So if you divide that by 3, then you can say, okay, gee, 27 days, it's well within the period. So they're both good on efficiency in that respect. So they look at inventory turnover, which is your COGS from your income statement, and that's again the cost of goods sold divided by inventory from the balance sheet. And this shows how many times a company has sold and replaced inventory during a given period. In other words, how fast is the company selling the products off their shelves? The higher the inventory turnover, the better. Since a high inventory turnover typically means a company is selling goods quickly and there is considerable demand for their products. Low inventory turnover, on the other hand, would likely indicate weaker sales and declining demand for a company's products. So if you look at inventory turnover, Disney is pretty solid, even though it's during the period of COVID. Uber, we'd expect to have 0 because from the prior pages, we noticed that they weren't including any inventory. Think about back to their asset test quick ratio. So we say, okay, let's look at the total asset turnover, which is taking the sales from the income statement divided by total assets from the balance sheet. And the total asset turnover ratio is used to measure the efficiency with which a company is using its assets to generate revenue. So think of it this way. An asset turnover ratio of 5.75 means that every dollar worth of assets generated $5.75 worth of revenue. I'll repeat that. An asset turnover ratio of 5.75 means that every dollar worth of assets generated $5.75 worth of revenue. So in general, the higher the ratio, the more, we'll say, turns, the better. But whether a particular ratio is good or bad is going to depend on the industry in which the company operates. So when we look at Disney compared to Uber, Disney is 3 times the size in terms of their asset turnover than Uber. And I would want to look at this to see what the valuation of their assets would be to generate and look at their impact. Again, it's not enough to take any of these ratios and put them in a vacuum. You need to go that extra step forward. So we look at then fixed asset turnover, which is taking the sales from the income statement divided by the fixed assets from the balance sheet. And this measures how well a company generates sales from its property, plant, and equipment. A high fixed asset turnover ratio often indicates that a firm effectively and efficiently uses its assets to generate revenues. A low fixed asset turnover ratio generally indicates the opposite, that a firm does not use its assets effectively or to its full potential to generate revenue. So now you can start looking at possible capacity issues as well. So fixed assets for Disney is 2.2. Uber has 0. Now, one can argue that the people they employ, contracted help, can turn into employees, which are assets, and you could determine the number of cars and so forth, but they don't do that. Us as the analysts would need to do that, but so the reporting for them would be 0. The OIROI, okay, which is also ROA, so the operating income return on investment, okay, this measures how effective, how efficient managers are in using the company's assets to generate revenue. The higher the ratio, the better, because the company is earning more money with less investment in their assets. So again, operating income return on investment, most investors would view an average annual rate of return of 10% or more as a good ROI for long-term investments in the stock market. However, keep in mind that this is an average. Some years will deliver lower revenues, or lower returns, I should say, perhaps even negative returns, and other years will generate significantly higher returns. So when we look at Disney, we say, okay, their returns are probably lower. However, look at Uber, they're negative. And I don't want to be like that they're a sinking ship. It might be a buy opportunity as well during these harsher times during the pandemic. Again, it's important not to take any one ratio and just run with it. You have to look at the bigger economic and non-economic indicators that are available. So then we say, okay, let's look at those leverage ratios, those solvency ratios. And we're going to look first at that debt ratio, which equals total liabilities divided by total assets, both coming from the balance sheet. The debt ratio can be interpreted as the proportion of the company's assets that are financed through debt. Again, think about whether a mortgage of a building, car loans, how much of something of the asset is owned compared to how much was financed to own it. So generally, a ratio of 0.4 or 40% or lower is considered a good ratio. A ratio of 0.6 or 60% is generally considered poor ratio. So 0.4 good debt ratio, or 0.4 or lower, and 0.6 and above is poor. And it's poor because there's a higher likelihood, a bigger risk that the business will not generate enough cash flow to service its debt. Got to remember, this also impacts the stock price. The higher perception of debt, bonds, which is leverage, which is risk, gives a higher perception of uncertainty in the market, which then perhaps will impact and lower the firm's stock price and must be managed. Well, Disney has a debt ratio of 0.27, which we know from, the scale of 0.4 and to 0.6 is very good. Uber is not available, or it's not applicable. I like to think that it's not available, and that they perhaps didn't want to show it, but further research will be needed from us. So then we say, okay, let's look at the debt to equity ratio, and we're going to take from the balance sheet the total liabilities divided by the total owner's equity. Okay, and the ratio is used to evaluate the company's leverage. Okay, and if you think about it, these debt management ratios, it's just the measure of the degree of which a company is financing its operation through debt versus wholly owned funds. So for debt to equity ratio, if I had a debt to equity ratio of 1.5, it means that the company uses $1.50 in debt for every dollar of equity. So the debt level is 150% of equity. Again, I'm going to repeat this. If a debt to equity ratio is 1.5, that means that a company uses $1.50 in debt for every dollar of equity. So the debt level would be 150% of equity. A ratio of 1 means that investors and creditors equally contribute to assets of the business. Investors, if you remember, are stockholders' equity. Creditors are those that give money to companies, such as for bonds. Okay, that's what I mean by creditors, or loans from banks and so forth. Okay, so a ratio of 1 means that investors and creditors equally contribute to the assets of the business, and a more financially stable company usually has a lower debt to equity ratio. Okay, the next is TIE, T-I-E, times interest earned. We're going to take EBIT, earnings before interest and taxes, from the income statement, divide that by interest expense coming from the income statement. And the TIE is a ratio, is a measure of the company's ability to meet its debt obligations based on its current income. So in other words, can the company pay the interest payments due on their loan and debt? The higher the ratio, the better, because it represents less risk. A TIE of 2.5 is usually considered acceptable risk. Okay, now the higher the better. Disney has 9.6, exceptional. Uber, again, not available. So we'd want to look and continue looking at the firms. It's important to note that debt management reflects the firm's equity position to cover all outstanding debts in the event of a business downturn. So brings us to profitability ratios, everybody's favorite. We start with ROA, net income divided by total assets, net income from the income statement, total assets from the balance sheet. And it measures how effective, how efficient managers are in using the company's assets to generate revenue. The higher the ratio, the better, because the company is earning more money with less investment in their assets. Again, the higher the ratio, the better, because the company is earning more money with less investments in their assets. Well, Disney has a 5.7, and Uber has a negative, for argument's sake, 27. Okay, so when you look at effectiveness, now you have to say, okay, what's going on? Now, I remind you of the time period this is taken from, and you'd want to look at others, but we're looking at this right now in a vacuum, one point in time. So then we look at the ROE, which is the net income divided by owner's equity. Again, it's going to be income statement divided, income statement and balance sheet. ROE measures the management's ability to generate income from the equity available. So in other words, how much revenue is generated based on the amount of stock, equity, people, investors buy in the company. It's important to know that the ROE considers the capital structure of the company, where the ROA does not. Now, again, Disney, it might be lower than prior terms for Disney, but Uber is significantly lower as a negative figure. It needs to be managed. It indicates, it signals trouble. Okay. Now, gross margin is something we talked about. I alluded to earlier as very important. Gross margin is the gross profit from the income statement divided by sales from the income statement. The higher the gross margin, the more capital a company retains on each dollar of sales, which it can then use to pay other costs or satisfy debt obligations. Again, I'm going to repeat this one. Gross margin, the higher the gross margin, the more capital a company retains on each dollar of sales, which it can then use to pay other costs or satisfy debt obligations. That's why when we talked about liquidity, it wasn't as important to me until I see the gross margin. Now, Disney's gross margin, 39.6, is excellent, and we know that their liquidity was 0.94, which was poor, but they seem to have enough monies to pay costs and satisfy debt obligations if looking at gross margin. If you look at Uber, they're in a terrific point. Their liquidity was up, their gross margin, they're getting more per dollar of sales. However, their efficiencies prior are hurting. So there are other things that we still continue and have to look at. So we go in and we say, okay, let's look at operating margin, which is EBIT, earnings before interest and taxes from the income statement, divided by sales from the income statement. And it's the operating margin is the profit a company makes on a dollar of sales after paying for variable costs, but before paying any interest or taxes. So when you start thinking about variable costs, I want you to start thinking, if you learned about contribution margin, that's what they're referring to. A higher operating margin means that the company has less financial risk. Operating margin could also be considered total revenue from product sales, less all costs before adjustment for taxes, dividends to shareholders, and interest on debt. Well, Disney operating margin, it shows you the profit per each dollar of sales. Disney's making a profit of 15.33, and Uber's losing on each dollar. So again, cause for concern, but then you have the gross profit margin that is telling us something different. So we say, okay, let's look at the net margin, which is net income divided by sales, both coming from the income statement. And this is basically the profit generated for each dollar of sales. For instance, I'm holding in my hand a pen, and my pen just say has a profit margin, net margin of 22%. It means that I make 22 cents on the dollar. So if I sold my pen for $3, I made 66 cents. That's how that works. So in terms of these profitability figures, Disney definitely seems like the stronger company, but again, you can't take everything in a vacuum, okay? You got to look at more information. So then you say, okay, let's see what the market is. So I look at Disney versus Uber, their market ratios. And market ratio compares the company's market value to its book value. The market value of a company is its share price multiplied by the number of outstanding shares, and the book value is the net assets of a company. Now, if you remember, the highly used leverage impacts now your market ratio because it's using the stock price of an organization to determine its valuation. Okay, so I first look at market to book ratio is equal market value of equity divided by book value of equity. And if you look, Disney is 2.3 compared to Uber. So it's still showing a strong value in the market, their perception. Again, even though there's some poor figures in profitability, the perception of the company could be of high valued, undervalued stock, poor performing for now, but will change. So then we look at the price earnings ratio, commonly known as the PE ratio, and it's taking the price per share divided by the earnings per share. And it's a ratio used to value a company by measuring its current share price relative to its per share earnings. So it's really a measurement of the predictive revenue stream of an organization. If there's a high PE ratio, then the organization, the company, is perceived to have a higher revenue stream that's expected compared to a low PE ratio. The problem is this. A high PE ratio means that then just might be too much hype, too much perception in the market that's generating all this publicity, this hype for this particular stock, making it overvalued, meaning that it's not that it's a bad stock, but you might be paying too much for it. You might be paying a premium. Low PE ratios, the company might not have enough buzz in the market, but could still be a solid purchase. Might be buy opportunities. So high PE ratios, granted, speak about earning potential, but you do run into some type of risk of overpaying for your stock. Well, Disney's, for instance, solid 43.48. Uber is sinking. It's negative. Again, it doesn't mean it's poor. It's just that it doesn't expect high revenues right now. Okay. Then we look at DuPont. Okay. Now the DuPont equation is another way of stating ROE, taking your profit margin, net income over equity divided by total asset turnover, divided times, I should say, your leverage multiplier, sometimes called an equity multiplier. And this helps financial managers better understand why their return on equity is lower or higher than the industry average by understanding other components that derive the same ROE calculation results. So it gives companies a way to dissect the ROE. They can say, okay, why is my profit margin lower than average? Gee, if it's my profit margin that's dragging down my ROE, maybe my prices are too high, maybe my prices are too low and my costs are too high. Perhaps it's my total asset turnover is lower than average. So I want to figure out why is that. So I look at that piece and say, okay, maybe it has to do with efficiency. It turns out that maybe I'm not maintaining the quality of the machinery that I have that's impacting the discrepancies, and I'm ending up with poor quality from the machinery. So it could be a quality issue. Okay. It could be an issue where there's no demand and the demand is falling because the marketing team didn't, do their position effectively, or it could be that my competitors are promoting their particular product with their enhancements and so forth, or it could be that we missed the mark in terms of what we thought was going to be hot. And then you say, okay, maybe it's the multiplier. Why is my multiplier lower than average? And again, the multiplier is an equity multiplier that indicates an adjustment factor for how much your assets are financed through debt and how much are financed through equity. Now, all of these ratios, does it tell us enough about the companies? What more do we need to make a decision? Now, obviously, we need a lot more information. Okay. Now, you can never just take one set of ratios. You can't just take one period of time. So you'd want to look at other factors. So the first thing I'd want to look at is possibly conduct a trend analysis or a cross-sectional analysis. A trend analysis looks at a firm's financial ratios over time. It compares the firm's performance this year with its performance in previous years. So now I have a tracking. I have more data points that I could look on. Again, any good forecast and I've done a number of multi-point regression analysis, and it's all dependent upon the amount of data points you have. So the more data points, more trending information, the better your analysis. Compared to cross-sectional analysis, which is a comparison of a particular metric, it's available in any of the financial statements. You just pick one. So you take one piece, maybe it's net income, maybe it's sales, maybe it's whatever line item you want of a particular company with the corresponding metric of another company within the same industry or against the industry average, and you start comparing certain line items from pieces of financial statements. Well, there also could be something called a timing issue. Okay? When you think of a timing issue, think of it as seasonality. Okay? Right now I'm in, Atlanta, southeast part of the United States. Well, it's cold, it's wintertime, and I'm not going to open up an ice cream parlor now. I might open it up 5-6 months from now if I wanted to. It's about seasonality. When would I get the greater demand? You could also start thinking about different industries have different fiscal periods, fiscal years. A different fiscal year represents different level of demand, hence a timing issue. Okay. You might also have what's known as an accounting issue. Accounting issues, they're, basically, if you think of them as the rules of accrual accounting, which allows for various policies regarding inventory cost flow, revenue recognition, as well as a variety of other issues. And this flexibility of GAAP, the rules, could have, mean that two firms that seem economically identical, that quite frankly aren't because of their accounting policies are different. For instance, think about how LIFO, last in first out, and FIFO, or weighted average cost principle, might affect net income. Last in first out, or first in first out in terms of inventory. Think of depreciation. Maybe one company depreciates, one doesn't. Maybe one does standard straight line depreciation, one does an accelerated depreciation. Well, if I'm going to have a depreciation, just say the company depreciates for argument's sake, a computer system worth $10,000, and it depreciates $1,000 a year, and at year 4 it's worth $6,000. Well, I would show a debit of depreciation expense, 4,000, and a accumulated depreciation credit on the asset side, 4,000. But I'm now taking 4,000 off my net income because it's an expense, compared to a company that has the same computer system that doesn't depreciate. Again, it all impacts their net income. So that's what they're looking at. Accounting issues can impact net income, which impacts, as you can see, many of your ratios. Well, what other information may be relevant? You'd want to look at the financial statements. And it's not enough to look at them in one period. You want to look at them in a number of periods. I just picked 3 years, and I took the balance sheet items for Disney and for Uber, and I just highlighted them in terms of total assets, total liabilities, and equity for both companies. And I'd want to start seeing the trends for these. And if I look at the balance sheet, perhaps I now can see what's moving the financial ratios in the direction that they were at. I see Disney, they went from their total assets doubled from 2017 to 2019, and their equity position more than doubled in addition to their liabilities. And I look at Uber, whose assets, what they own, doubled, but their equity position went completely, more than doubled. It went from a negative 8.6 to a positive 15. So you can guide to see they reduced their liability holdings, doubled their assets, and now you say, okay, that might explain some of their ratios that we were looking at. So then we say, okay, if we have the asset earning base of the company, let's look at the income side and expense side. Because you got to think of it. the income statement is really the operational report of the company. It shows the money coming in and the money going out. And for Disney, we look at from 2017 to 2019 that their revenue increased dramatically. However, so did their expenses. So their EBIT was flat, earnings before interest and taxes, which makes you think, okay, what did they purchase? What did they buy? And now you can see how that would impact some of their ratios. Uber, we say, okay, they went and doubled their revenue in the time period. They doubled their expenses, but they also almost doubled their negative impact. They went up, and now that makes me think that perhaps there was some more investment, FDI on their side, possible foreign direct investment, that might have impacted their figures as well. So then, I say, what else do we need? There's not enough information here just to make a decision on which company I would invest in or which one I wouldn't invest in. Again, ratios gives you some of the information, a profile of a company, but if you're going to look at it as an investor, you'd want to see how it interacts with the rest of your portfolio. Now, other things that you'd want to consider in terms of sustainability for a long-term investment, you'd say, okay, that Uber was founded in 2009, so it has a good history. It's in 85 countries. It has a number, half a dozen growth initiatives, and it has almost $32 billion in assets. So now when you start looking at the other ratios, the ones specifically that utilized assets, now they could be magnified because they have some earning-based potential, a user earning-based potential. Now, if you look at Disney, it's about 100 years old. It's in 40 countries. Yes, I imagine it is the most magical place on earth, has a lot of different revenue streams, but it also has close to 194 billion. So again, just because we saw some ratios that were better on one company than the other, when you see the magnitude of the impact based on the asset-based potential, it gives you another view of what to look at. So other things to look at, what about during the current economic environment? During this pandemic? Well, Disney's revenue in 2019 was almost $70 billion. Disney reports a 58% drop in operating income from their parks and cruises, worst hit segment. That 58% drop is also in their largest moneymaker. So you'd have to consider that. Uber made 14.15 billion, but it also included a net loss of 2.9 billion rather. They laid off a lot of people and going through a major lawsuits, which will impact. I just like this screen. This is a picture of all the companies Disney's owned. I just thought it was apropos. So if you look at Walt Disney's resorts and you look at where they're operating from, and you can see that the earnings per share, they diluted earnings per share from operations in the quarter. Now you can start thinking about the ratios that impacted, and it decreased 37%, $1.17 from $1.86 from the prior year quarter. So now you just start looking at more and more information. And again, there's a lot here, and we don't have to go through all of this, but I do want you to look at the cash flow. I want you to look at the earnings per share, look at the revenue changes. Look at, in Uber, their major investors. This is where they're investing their money. Again, where they're investing overseas, foreign direct investment, and how it's broken down into debt and equity. That also is impacting their ratios. Shows you how they raised equity in Uber, with their debt position, fundraising, their conversions, what their long-term initiatives are, their strategic plans. So as you can see, there's a lot, and I'm going through these a little bit faster now because these acquisitions for Uber, and this is just since 2020, Uber acquired 1, 2, 3, 4, 5, 6, 7 other companies, and they continue, and they continue. So it's things to continue to look at. You just can't take the negative and poor ratios you got to see what they're investing in and so forth. So I'm going to end it here. I'm hoping you found value from this presentation. If anybody has any questions, please feel free to email me. I'll be more than happy to answer and address any question that you may have. I'm hoping you're enjoying your class and have a wonderful rest of the day. Take care.